This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Welcome to The Commercial Investing Show, where we analyze, explain, and exploit the opportunities presented in today's commercial property marketplace. If you're interested in apartments, mobile home parks, self-storage facilities, and other income property, you've come to the right place. We'll explore what's hot and what's not in markets nationwide in the relentless pursuit of return on investment. Here's your host, Jason Hartman.
It's my pleasure to welcome someone I have been following for many, many years, and that is Jim Puplava. He is founder and president of Financial Sense Wealth Management and host of the Financial Sense News Hour. And I started listening to his podcast maybe 15 years ago when I started podcasting about 14 years ago. And he's had a big impact. He's got some very interesting insights into the economy and the markets. And I just can't wait to have him on the show finally today. Jim, welcome. How are you?
Very good, Jason. Good to be with you.
It's great to have you after all these years that I've been listening to you. You know, Jim, you've got some great insights into the economy and the markets, as I mentioned. Just want to talk to you about those. So here we sit with still a relatively new administration. We've got a huge tax reform, and I think that's going to have a negative effect on a lot of these high-priced, markets like, my home state, the Socialist Republic of California, and I know your state, and New York, these sort of high-tax areas that have been driving a lot of the producers out over the years, kind of slowly as people vote with their feet. Do you think this will accelerate that exodus or have much of an impact? What do you think about that? Let's dive in with the tax plan first.
I think it's definitely going to have an impact on real estate here, especially on the high end, maybe not so much on the low-end real estate. And it's also going to have an impact on businesses and individuals leaving the state. As you live here, it's a state of basically two classes of people, those that have money and those that don't. And the situation is getting much, much worse. I interviewed one of the nation's top tax attorneys out of Los Angeles, and he said, he had been experiencing many of his clients were leaving the state, but he said he has seen an acceleration in the last couple of years because, as you know, Jason, they raised tax rates in 2010, then they came back 2012, they raised them even further. We're now the highest tax state in the country. Now, that was okay if you were in a high federal tax bracket because you could deduct your property taxes, your state taxes. Well, now you've got a limitation of $10,000 on property taxes, which is next to nothing since property taxes are high here. Yeah. And then if you're in a 13.3%,
you're just getting killed.
Bracket, you're getting killed.
It's unbelievable. It is yet another of the many examples of the disaster known as socialism. And we're galloping toward it in some areas. But interestingly, in some ways, we're moving away from it, thankfully, after 8 years under Obama. I mean, Trump is such an odd bird. It's hard to figure him out for sure. Maybe that's intentional on his part. But I do think as we see this sort of issue with the SALT areas, the state and local taxes and so forth, that is going to be a further incentive for people to leave or to not purchase high-end homes. And by high-end, we just, of course, mortgage interest now over $750,000 will not be deductible. And in a place like California or New York, hey, that'll barely buy you a shelter, so...
it's probably just a storage unit here.
Exactly. It's a pretty significant attack. Any more thoughts on how that might play out for us?
Yeah, there's a book I read a couple of years ago by the credit analyst Meredith Whitney.
Oh, yeah, she's been on the show. She's great. Yeah, the state of the states. Yeah,
and she was talking about there is going to be this reverse migration. I mean, if you take a look at, since World War II, it was kind of like go west, young man, and everything was moving towards the Midwest and then to the West Coast. And she's talking about a reverse migration now where you have people on both coasts start to move inland to areas like whether it's Arizona, it's Texas, New Mexico, places like that where the cost of living is cheaper. You've got, and you can see this right now, you've got some of the high-tech companies. Were they opening up new factories? They certainly aren't doing it in California.
Yeah.
They're doing it in San Antonio, Austin, Texas, and they're doing it in other places of the country where taxes are lower, cost of living is lower, regulation is lower. And I think this trend is just going to accelerate as a result of this tax bill, because up until this point, states like California or New York or New Jersey or any other high-tax state, well, the high-end people, they could deduct that on their federal tax return. Well, no more.
Yeah.
And I was just reading in the state of Connecticut, one hedge fund manager moved himself, he was a billionaire, and his whole hedge fund operation to Florida. Yeah. Well, the state of Connecticut lost $200 million in tax revenues. And that's what's happening here. But what do? As you know, Jason, they keep coming up with more taxes. Last year, they raised the tax on gasoline 20 cents. They raised the tax on cigarettes and cigars by $2. Then on top of that, if you were green and you bought yourself a hybrid, then they raised an extra $100 vehicle fee, and now they're talking about, for those of us that have solar-powered homes, raising some kind of fee or an assessment on us. So, in my own opinion, they're headed for bankruptcy because they have a pension fund that is unfunded to meet its obligations, and they're scurrying around every which way they can, whether it's assessments on, your car, it's cigarettes, it's gasoline. They're just reaching everywhere they can. I mean, if it moves or breathes or walks, they tax it.
Yep, that's true. And this is this is why I had to leave California after living there virtually all my life. I left in 2011. There are so many hidden taxes in terms of things like traffic tickets, and a government that basically, Jim, becomes predatory as it becomes desperate. It becomes predatory on the citizens. The government has gone into business against the citizens, and they look for the low-hanging fruit, and they always do it under the guise of public safety or whatever. They'll always have a reason, right? That's just what they do. But, the question is, how much will people tolerate? And what will be the ultimate outcome? So, California won't really go bankrupt, right? It'll get a federal bailout. What will it do? What's the end game here for all of the states that are in this predicament? And it's not just California by any means. A lot of municipalities also are in trouble, and we saw some municipal bankruptcies. In fact, I think it's kind of different how they do it, but the concept is similar. What's the end game? I think it would just be a federal bailout, print more money and just bail them out. That's what they'd have to do, right? Or wrong?
One of the things I'm watching, there's going to be some court cases coming up in Illinois, and they have a severe pension problem. And as you know, with bankruptcies here, with any of the cities, the bondholders got the shaft, and the courts would always uphold pensions as sacrosanct. And I think that's going to change. I think you're going to see eventually, just as defined benefit pension plans went the way of the dodo bird in corporate life, you're going to see it at the government level. Governments simply will not be able to sustain the type of pensions and salaries. One of the things that you see here, and this was brought up in a recent study on the cost of education, there are so many administrators, and one of the little things that they do here is say I'm an administrator, I don't know what I'm doing, but I'm getting paid $250,000 a year. Well, what I do is about 5 years before retirement, I retire, receive a pension. They hire me back as a consultant. Now I'm making double the money, and I double-dipped 5 years before I retire.
Right. On the national level, you've talked a lot about Social Security, and basically, I think 2027 is the number. I've had Lawrence Kutlikoff on the show a couple of times, and you've probably interviewed him as well, I assume, and he's done a lot of studies about the unfunded entitlements, unfunded mandates coming at us over the next 15 years, and boy, that's going to be interesting.
I think eventually what they're going to do is, if you take a look at Social Security, it was tax-free. And then in the Social Security reform in 1984, it became subject to 50% taxation. Then under Bill Clinton, it became subject to 85% taxation. Eventually they'll go to 100% taxation, and then they'll go to some kind of means testing. If you make X amount of dollars, you lose so much of your Social Security benefits, to the point, if you're Larry Lots of Bucks, they just basically phase it out.
Well, we've seen this. People are moving to Puerto Rico. There's a huge tax incentive there. You may not have electricity, but save a lot on taxes. I just sort of don't know what comes of this. I mean, is there going to be a significantly inflationary future? Inflation seems to be the greatest business plan for governments, because they can just continue to buy votes, they can spend, they can mismanage, and they can just inflate the problem away. It's like boiling the frog slowly, right? Is that our future? And I don't know where you stand on the inflation-deflation debate. I mean, maybe I did years ago, but don't know recently your thoughts.
Right now you still have a disinflationary force, and that's coming through technology, or what I call the Amazon effect. And you also have, Jason, the fact that even though the Fed created a lot of this money by buying bonds, a lot of it stayed on the balance sheet, banks holding that money with the Fed. So you have not seen the kind of credit creation that we had leading up to the housing bubble that was driven by, heavy mortgage debt. But I think some point in the next decade, and it's inevitable at this point, because you have 70% of the government's budget is Social Security, Medicare, and interest on the debt, which leaves only 30% for defense and discretionary spending. Well, that's on automatic pilot. And if you look at the Congressional Budget Office for 2019, the government's fiscal year, which will begin in October this year, they're already projecting a $1 trillion deficit.
These numbers are insane. I mean, wow.
They're crazy.
Yeah.
And that number could get bigger because they've got this 2-year budget deal that's going to increase spending by $300 billion. Now they're talking about infrastructure spending. And so you add that to the fact of 10,000 baby boomers retiring every single day. What is that doing? It's putting more strain on Medicare and Social Security. That is going to escalate, and that is going to increase. You add that to interest on the debt. I mean, Obama was one of the luckiest presidents because he doubled the national debt from 10 to 20 trillion. But every single year, Jason, the interest that the government paid out on the debt actually went down. So his last year in office, the government spent $20 billion less in interest expense at $430 billion than when they did in 2008, when the interest on the debt was $450. Now you have rising interest rates, and you have two factors that are kicking in.
So you're saying hang on one sec. You're saying Obama got lucky simply because he was in a declining rate environment, or was there more to it than that? But don't forget your other thought.
He was in a declining interest rate environment, because I don't think Trump will be as lucky.
Yeah, that's true. True, I agree.
Yeah, because you just take a look at the average interest rate. If it goes up 1%, that's $200 billion more in interest expense.
Yeah.
So, it's not going to be too much further in the next couple of years. We're going to start seeing the government shell out $600-700 billion a year in interest expense. That's a lot of money.
Insane. You can't write fiction this good, Jim. It's just crazy. It's nuts. But the question is, people have said this for a long time, these kinds of things, right? I mean, I remember I had Howard Ruff, I believe he passed away, but, he's been on my show. There have been a lot of these kind of like doom and gloomish predictions for decades now. And they just haven't come true because they can keep kicking the can down the road. And it never seems like, to use another saying, the chickens come home to roost. When's that going to happen? Or is it ever going to? Maybe we can play this game for the next 100, 200 years. I don't know.
I think it's somewhere around the next decade because, if you take a look at our debt levels compared to GDP, we still have the best-looking house in a bad neighborhood.
Yeah, right.
So we've got further to go on this. I mean, just look at Japan. I mean, if you take a look at their debt levels, look how long they've been able to get away with this. Uh-huh. So I still think it's probably, maybe within the next 10 years, because at that point, when you start getting into trillion and a half, $2 trillion deficits, I'd like to see what they're going to do in the next downturn. Because if we're at $1 trillion next year, with the economy growing, with unemployment at the lowest level, what does that deficit look like when we actually get into a recession, when people lose their jobs, revenues decline for government, and expenditures with Medicaid and unemployment and all those things go up? We could be looking at $1.5–2 trillion deficit.
Okay, so what does this mean? Does it mean inflation? Does it
Longer
mean
term,
they'll print their way out of it as usual? That's always the answer. It just blows my mind, Jim. Every time you see a G7 meeting, a G20 meeting, anybody meeting, right, at Davos, the answer is always increase the money supply. That's the answer to every problem, right? Throw gasoline on the fire, Now, granted, there's a contraction going on right now, and, we'll see if they can manage that so it's a soft landing. Of course, the history isn't good on that, as you say. Ultimately, it just seems like that's the only business plan, right, is to just increase the money supply.
I think when you really start to see the inflation kick in, you heard about the Fed's balance sheet going from $800 billion to $4.5 trillion. But a lot of that didn't get out through the banking system in the form of credit. It remained on the Fed's balance sheet. When I think you see the full impact of an inflationary Fed is when the government says, we're going to do an infrastructure program. We're going to spend an extra $200 billion a year, and the Fed will just come in and monetize the debt.
Right. And so that's inflationary.
That will be inflationary. Government spending more money than actual production of goods and services, and it is being monetized. And, we really haven't seen that yet. So that's why I think when we look at this, inflation is in our future. And, whether it will get to some kind of crisis where it's not being able to be funded and the government is forced into a straitjacket, much like Great Britain was, and, whether we go the route of Argentina, I think I don't know if we're going to see that before something else happens in its place.
Oh, interesting stuff. So what's kind of the strategy? Like, what do you think people should do? Our people want inflation. It may, philosophically, I hate inflation. But as an investor in income-producing real estate, I love it because inflation, of course, it's a good hedge. That's the simplistic overview that everybody knows. But more importantly, inflation basically pays down the debt for you. You pay your debt back in cheaper dollars, or really your tenants do. So it's something I call the double inflation arbitrage, which is fantastic for real estate investors. Is like this hidden wealth creator is inflation, but it's pickpocketing everybody else. It's not good for society, but it does appear to be really good for income property investors. Thoughts?
I like real assets, whether it's real estate, whether it's, things like precious metals or, quite honestly, stocks. And I think we're in this period right now where stocks are the advantaged investment, and we've seen it, since this economic recovery. And I think right now is we're just about ready to go into what I call the final sequence of a topping process. We've seen the bond market has already peaked, and stocks are still going full head of steam. But there's something we're watching very closely. We're watching the dollar, which has been declining since January of 2017. And if you look at the summer, going back to June and July last year, you saw oil start to take off, you saw base metals start to take off, and you're seeing commodity-related stocks start to take off. What we haven't seen yet is the real breakout of what I call the commodity currencies, Australia, Brazil, Canada, but they're rising. And so there's a subtle shift here, but the leaders in this market are still what they were leading up to this last correction. Consumer discretionary stocks, technology stocks, industrial stocks. They're still in a leadership role. What we're watching is for that switch to start subtly taking place, where you start seeing energy and commodities start moving into a position of leadership, which is what you do towards the end of a business cycle. We saw it happen in 1999 and 2000. We saw it happen again in 2007 and 2008. So that's what we're watching right now. And I think the most dangerous thing that your listeners could be doing is this passive bubble in what I call index funds, where it's mindless investing.
Yeah,
you
right.
take 90% of the trading on the exchanges, algo traders, and index funds. Well, those index fund investors got a taste of what it's going to be like in the next downturn in the correction that we just went through.
Talking about a downturn, do you think we're going to have another sort of great recession, if you will, or a big downturn, or will it just be the typical run-of-the-mill, recession that happens on the business cycle? And, depending on what you think about that question, what would be the cause? Is it simple contraction of money supply? Is it... there are so many factors.
I think eventually the Fed is going to raise interest rates. One of the things that we think is an anomaly right now is you have massive stimulus coming in at the end of a business cycle. You typically see it at the beginning. At the same time, you've got a contractionary monetary cycle. They work best when they work in unison. So I think this next downturn is going to be, Jason, relatively mild. And the reason I say that is they just increased in the budget $300 billion of additional spending on the military, social programs, you name it, they're spending it. And then what they're going to do is they're going to put in place a trillion to $1.5 trillion in infrastructure spending. Well, you and I know the way Washington works with bureaucracy, environmental laws. It takes forever to get something in place that is shovel-ready. They're going to pass this, but it'll take a couple of years to implement. So, when we get into the recession, coming out of that recession, you're going to see massive government fiscal stimulus coming in the form of infrastructure spending that will carry us through into the next cycle, which will be more inflationary than the previous one.
Mm-hmm. Yeah. It begs the question, how does this affect the largest demographic cohort in American history that is going to be impacting the economy in a huge way shortly? And that's the millennial generation, of course, the too much talked about and way too much catered to generation of millennials out there, 80 million or so strong. They've got incredible student loan debt, which, talk about a scam. That's just an epic scam. The whole college, I call it the college government industrial debt complex. What a scam that is, tuition prices and so forth. They're in a somewhat anemic long-term overall economy, I believe, but they are going to eventually inherit some money. But then you look at these stats about how, huge swaths of the American population have less than $1,000 in their savings account and nothing in an IRA or saved for any kind of retirement, and combine that with the Social Security problems coming our way. And it just really, as all these factors coalesce, it just really makes you wonder how things are going to work out, especially for the millennials. And, the baby boomers changed everything, of course, and they're slightly smaller than the millennials, but a hugely different set of circumstances.
I think you have the makings of a very disenchanted generation. Mm-hmm. And the scary thing is, could it be revolutionary? Yeah. Because a lot of these people, as you just mentioned, are out of college with huge debt, with degrees that are not appropriate for getting a job in today's high-tech society. And we've interviewed a couple people that are starting the equivalent of what I call apprenticeship programs, mm-hmm. where you don't go to college. You go through advanced...
I heard that interview. That was great. Yeah, good idea.
Yeah, and I think that is going to be more, if the millennials are saved, it'll be through programs like that. Because, the typical millennial that goes to college comes out with a degree that, you can't get anything, a decent paying job or the skill set. And the other thing is this entitlement mentality is harming their basic job skills. I know a consultant who works with corporations to handle millennials because, he was telling me about one gentleman that basically decided not to come into work for a couple of days and didn't bother to call. So it's I don't know, it's going to be a big wake-up call, I think, for many of these.
It's interesting. We can look at all this stuff, and in the context of history, certainly it's hard to argue with this. And, I have another theory I've been working on, Jim. And it's that the millennial generation, in a lot of ways, they have a better life because of the sharing economy, because of technology. I mean, things are cheaper and dramatically better. I did not grow up with an iPhone. Okay, these millennials grew up with iPhones in their back pocket, right? You know, if I could have a television set and the access to information that they had that just was second nature to them and totally, you know, they felt entitled to and expected, if I could have that when I was a kid, it would have been like my dream come true to be able to watch TV in the car or watch videos in the car as mom was taking me around town or something, right? So in some ways, things are dramatically better because of technology, right? And the access to information and resources through the sharing economy, rides with Uber and Lyft, et cetera, bicycles on demand, all these kinds of things. But you wonder what's going to win in this war. And I look at it as a war between bad government, fiscal, central bank policy, right? And technology on the good side, right? Technology is a deflationary force, but everything the government and the central banks do is an inflationary force. And I'm not saying government singular, it's governments plural, just all around the world. So how do we know who's going to win this war between the two? I think that really determines the future. And just to give you a little more to chew on here, the theory I'm working on is that the millennials, even though they have a better life in a lot of these ways with technology and such, they aren't entering what I call the investor class the way my generation, Gen X, did. They're not buying their first home at age 24 or 26 very often. They're still living with parents, right? Now they are entering the housing market, but as a percentage overall, it's much lower than before. They don't have those stable corporate jobs that are paying high wages that prior generations had. You know, with all this asset inflation we've had, I don't know that they're really able to enter the investor class. And if you project that out 10 or 15 years, that puts them very far behind. Add to that student loan debt and all the other issues. It's hard to figure out where it's going with that.
Well, you know, the thing about technology, you look at the millennial lifestyle might be less than, let's say, the boomer lifestyle. You know, that they're content to take Uber instead of own a car.
Right.
They may be content to own a small apartment in the city versus a house in the suburbs.
Right.
And so it's a different, in terms of human needs and wants from material possessions, it's a different type of, you know, the iPhone is probably more important to them in earbuds than, you know, having nice clothes or a nice car to drive.
Right.
The other thing, too, is they're going to be inheriting some money.
Yeah, right.
So it'll be interesting. Now, we have apprenticeships in our organization. We have 3 millennials that work for us. And Jason, I can tell you, you know, a lot of it is upbringing because these people are ambitious. They're hardworking.
Yeah.
And it's almost like an anathema to the generation model that people think of. So it's going to be interesting. But I'll tell you, I think you're going to see a lot more convulsions, a lot more volatility in the next decade because we are now reaching critical mass when it comes to debt. You know, we're going to be at $21 trillion. And starting next year, we're back to trillion-dollar deficits. So that number can climb very quickly. And it's going to be interesting because I think it's going to put a cramp in terms of the government's ability to do things that it wants to do. And the only alternative it does want to accomplish or spend money, it'll have to be monetized and printed because there simply won't be the tax revenues there to support it.
Yeah, we shall see how it all goes down. Jim, give out your website and tell people where they can find you.
They can come to our website. It's Financial Sense. That's Sense with S-E-N-S-E. That's financialsense.com.
Good stuff, good stuff. Any closing thought you want people to hold on to before you go?
We haven't seen the final leg of this upturn in the market yet, believe it or not. We've got tax rates and tax stimulus kicking in, and on top of that, government spending and stimulus. So it's only going to end when the Fed does what it always does, which is crash the airplane.
Yeah. It would be funny if it weren't so sad. So I don't mean to be laughing, but there's definitely some truth to that. Jim Puplava, thank you so much for joining us. Appreciate it.
You're welcome, and thanks for having me on your program.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.